Hi, this is Unbring Capital back with another video. This is not going to be any way related to market analysis. This is going to be a video on how to trade appropriately, how to size your positions in a professional way, the calculations that need to be done in order to appropriately size a trade, and also how to use leverage appropriately and not fuck yourself up on both of those points. So at the end of this video, whether or not you choose to take this advice, you should at least have an understanding of how to properly position size your trades based on the trade signal, not based on how much money you want to win or putting your stop a million miles away because you have no edge and you've got no means of actually generating a trade idea. This is going to be a proper process from start to finish of identifying on a chart a particular idea, identifying an entry point, identifying a point at which that idea will no longer be logically correct, and that is where you put your stop loss, and then trying to figure out a profit target. And it is when you have done that, you have determined what your entry is, and most importantly, what your stop is, then you insert that as a function of the amount of money you want to lose if you're wrong, i.e., if your trade goes to the invalidation point, and then you size your position based on that data. You do not size your position. I'm going to put my stop 50% away because I've got no edge. I don't know how to generate a trade idea and I just want to be involved because I'm a degenerate gambler. No. Entry and exit, when you're wrong, i.e., stop loss, comes first. Then you determine what percentage of your portfolio you wish to risk, and then you let that automatically calculate into a position size. So before us on this screen, I have a long and short position sizing calculator, which requires a couple of inputs, but most of the data will calculate automatically. The information that this needs is your account balance, which is the full size of your portfolio, margin posted, that is the amount of margin you have committed to the exchange that you want to place the trade in. Obviously, if that is the same as your account balance, your leverage will be 1 or you'll have no leverage. If you have less than the margin posted than you need regarding your account balance, then you will need to use leverage. And I'll get to that later in the video because this is the appropriate way to use leverage. It is not to blow up your portfolio. Well, it actually is to blow up your portfolio. It is not to inflate your portfolio value to make more money from a trade idea. That is retarded. That is a gambler's way to use leverage, and that is not how a professional uses leverage. We'll get to that, as I said, later in the video. So in order to be able to properly size your trades such that you can stay in the game long enough to have your edge materialize, because if you have a portfolio and you risk 50% on trades, then 2 trades and you're out of the game, basically. Well, technically that's not true, because as your portfolio decreases in value, so too does the nominal amount of the percentage risked. So if you lose 50% of a portfolio, you're going to basically have half the portfolio that you started. If you lose 50% again, you're going to have a quarter of the portfolio that you started with. So over time, you are going to diminish your portfolio. So it's not as simple as saying percentage portfolio risk equals the amount of tries you have on an idea, because it doesn't converge towards zero in a linear fashion. However, let's just take a hypothetical example of a $100,000 portfolio. And for the first part of this, I have 100,000 posted to the exchange. Obviously, that's pretty retarded. As FTX showed, if you are 100% committed to an exchange or to any counterparty, you're a fucking retard. And I'm happy to say that because I was that guy just over 12 months ago. So lessons have been learned, and that will not happen again. So we have a $100,000 portfolio. Generally, default will be 1% to risk per trade. So what we need is to get all of these values. Obviously, they're showing value errors because I just have the price points as inputs currently. But we're now ready to take an example from a chart And there's going to be no edge demonstrated. I'm going to pick two price points at random, and I'm going to use them to demonstrate how this would work. So we go to the Bitcoin chart. There's no real trade there on the weekly time frame, but let's just assume that we think, and this is not about idea generation. This is a separate process. This is about when you have your idea, how to properly size it so that you don't fuck yourself in the long run. So let's say we do think Bitcoin is going to go back to an all-time high. And we have determined that we don't think it should exceed this low if it's going to do so. Reasonable, not a groundbreaking edge, but it is a reasonable thesis. That in clearing this value high, where it was a net selling vector candle, that price should not venture down towards this area again if it is going to go here. Now, I don't think that is going to happen, but if I did, this is how you would trade it. So the current price is here. So we have our entry price, we have our profit target, and we have our stop loss. Now, obviously, symmetrically, you can see the risk reward of this trade is going to be dog shit, but it doesn't matter because we can still illustrate the point. So price is around 52,700. So we would set that as our entry point. Done. Stop loss is around 38,600, but we'll go a couple of ticks below. So we'll set our stop loss at 38,000. And we'll set our profit target at the old all-time high of 69,000. Now, this is not a great trade because I haven't used any data analysis to choose it. But the point is, you probably don't even have to have a moderate return on your trades as long as you're properly managing risk. So we want to lose 1% when we're wrong. So 1% of 100,000 portfolio is obviously $1,000. So we see that's automatically calculated here. Loss if stop hit $1,000. We can see gain if profit hit, which is literally just the position size based on the difference between the entry and the profit. And we will get an indication of the amount of the asset we need to acquire, the size of the asset denominated in the asset, our risk reward ratio, our percentage to stop, percentage to profit. These are all kind of circular data points, all saying the same thing. But the key thing is we have defined our risk as 1%. We've inputted the variables that we have chosen as being the relevant variables. Obviously, as your edge grows and as your trading instincts develop, you will pull your stop closer to your entry point such that your risk reward will increase. But this is a brain dead trade idea to illustrate how you would properly manage risk, even though it is a brain dead trade idea. So we see that we need 0.07 Bitcoin at a position size of $3,585.03, and that is calculated on the basis of our account balance and the percent we want to risk. So it's really honing in on this $1,000 risk. And what it's calculating here is the difference between your entry and your stop. So the difference between, you don't even need a profit target to be able to put a trade on. If I take out this profit target, we still have all the data we need because the position size is a factor of your percentage risk that you want to take on as a function of the distance between your entry to your stop. So we have a $14,700 difference between the entry and the stop. We want to risk $1,000, therefore our position size is going to be 1 over 14, and that is how we get to this 0.07 trade size. And that is how you do it. That is essentially how you do it. And that is how you detach emotion from the situation. If I know I'm only going to lose 1% of my portfolio on this idea, I do not give a fuck about this idea. I've already priced it in. I'm losing the $1,000 if it's wrong, based on this hypothetical portfolio value. So a way to hack your trading psychology to be able to make peace with that is to just treat that like an entry ticket to an event or a raffle ticket. Assume the money is gone, and as price starts to if let's say price started to bleed down towards the stop, you're getting emotional, you're sweating, you're sweating, you're sweating. Why is this happening? Because you're overexposed because you didn't manage your risk properly. This is the maximum I can lose. The assuming good liquidity on the exchange, when price gets to this point, it will sell my entire position and my account balance will now be $99,000. That is how you get rid of the stress, the risk, the fear, the sleepless nights. It's like you've done the work in advance. You've calculated the trade uh, variables. You've determined I want to lose this. This idea to me is worth this. And that's when over time you start having gut feel like this is a 2%er, this is a 4%er, based on your confidence in the idea and based on the the data that overlaps to give credibility to the idea. Fear and stress and being afraid and shitting the lows only comes from being overexposed. And the reason I know this is because I had to go through that to learn that if price is trickling towards your stop loss and you're feeling like a piece of shit, it's because you're overexposed. If you do this work in advance and determine that I only want to risk X on this trade and use a calculator to figure out exactly what that number is such that there's no guesswork, you can just walk away. Assuming good liquidity on the exchange, your stop loss will be hit, your trade will be closed, and you'll lose exactly what you thought you were going to lose. Obviously, you get into issues when there's fuck all liquidity on the exchange and your stop at 38,000 doesn't get triggered, gets triggered at 32,000. But that's up to you to determine the quality of your counterparties, both in terms of risk exposure and also the liquidity, such that you don't find yourself carrying a bag that you thought was closed out a long time ago. So hope that helps make sense of the order in which you come to put a trade on. You do not say, I have a 100 grand portfolio. I really want a $1 million portfolio. This is a 10x trade. I'm going to go all in. Yeah, if you're right, you will hit your goal. But if you're wrong, the distance to stop in this example is 27.89%. If you put a 100 grand portfolio all in on this trade idea and you're wrong, you're losing $28,000 from your portfolio. That's a disaster. That's a disaster. That's being a piece of shit with no methodology. Like picking the trade ideas is only half of the equation. In fact, you could argue that I just picked these fucking price points, out of thin air. Yes, it is a credible trade. It's not a very attractive trade. It's not a very high value or data driven trade, but it is a trade. You do this part first. It's arguably less important. What's more important is this part, determining exactly how much to put on so that you can have 100 goes at this so that over time you're letting your edge make you profitable, because over time you're going to make more when you're right than you lose when you're wrong. But if you blow up your portfolio because you've lost 27.89% on a trade idea, then how are you ever going to get to the long-term goal of maximizing the profitability of your edge? You're simply not. You're going to blow up and you're going to be one of the 99% that never makes it. By all means, focus on idea generation. Bring the goal of trading, in my opinion, is to bring your stop loss as close as possible to your entry, such that the risk reward is stupid. For example, and you do that by dropping time frames and looking for data driven swing points closer than what your stop loss actually was. But that's beyond the point of this video. The point of this video was to illustrate that you can properly position trade sizes based on dog shit trade ideas. Now, let's think about leverage. Leverage is very important in the trading world, but not in the sense of crypto degenerates on Binance with 125x leverage blowing themselves up and then blaming other people for blowing themselves up. Leverage is not to increase the value of your net portfolio such that you can make more money when you're right. The professional use of leverage is to minimize counterparty risk by not having to have the totality of your portfolio exposed to a counterparty in order to trade. In this example, I only needed 3,500 of this $100,000 portfolio to put this trade on, because the loss was a 27.89% function of the $1,000. So, if $1,000 is 27.89, which is what we've calculated because we want to lose 1% and the stop is 27.89% away, then the position size is going to be basically, uh, 1,000 multiplied or divided by, sorry, 27.89 over 100, and that's where you get this. So I don't need to be having 100,000 on an exchange. I don't even need to have 3,500. Let's say I wanted to only commit $10,000 to the exchange, okay? Because I don't want to have FTX 2.0 happen and they blow up and they take the entire portfolio. So I'm gonna commit 10% of my portfolio in cash to an exchange. But I want to be able to, obviously, if I'm properly trade idea generating, my stop is going to be much closer than this randomly picked value. And as such, I might need the entire clip. Even though I'm only losing 1%, which is 1,000, my stop could be so close. Like if my stop is 1% away nominally, then I'm going to need the full 100,000 clip in order to put the trade on. So in that instance, I don't want to commit 100K to Binance or fucking BitGet or KuCoin or any of those Ponzi cunts. I want to protect myself. So if I need to put 100,000 trade on and I have 10,000 margin posted, what am I going to do? I need to use 10x leverage in order to bring my portfolio to the size that it needs to be. So the idea is you have your 100,000 or you have your 90,000 in a bank account. I was going to say the word secure, but secure relative to offshore crypto exchanges or even onshore brokers. I'm just have the heebie-jeebies about counterparty risk since 2022. That's a lesson you only need to go through once before it clicks fully. Either that or you're just not supposed to be in the game. If you get wiped out by a counterparty fraud and you don't take action to protect yourself after that, then what happens next is on you. So I will take that 90,000 in the bank account and leave it there. And I will take 10,000, put it on the exchange, use 10x leverage, and I'm effectively trading the 100,000 portfolio, but I only have 10% of that exposed. So 90K in a Barclays bank account, for example, 100K, or sorry, 10K on the exchange, exchange goes, and I only lose 10K as opposed to the 100 that I actually have in the portfolio. I'm keeping the 90 safe, putting 10 on the exchange, blowing it up 10 times such that it matches the portfolio that I have. And that is the underlying point and the crucial point. It matches the portfolio that I have. If you are using leverage to put your effective portfolio value beyond the cash that you actually have, you're using leverage wrong, you're likely gambling, and it's going to end badly over time. Yeah, the first couple of trades might be good. Oh, look at me, I'm making 10 times what I would if I was just a wee beta bitch trading my actual portfolio size. But then the streak of bad trades comes. And a professional knows this. It's only around the corner before you start missing the target. And if you're leveraged when you're missing the target, imagine the euphoria and the fun when you're leveraged making gains. And multiply that by at least 2 times when you're making leverage losses and your portfolio is evaporating before your eyes. That is the appropriate use of leverage. So I hope this video was helpful, both in terms of not putting the cart before the horse in terms of position sizing. Do not go in looking at a chart or a trade idea and thinking about max gains that I could win. You must start with determining a rational entry point and a rational stop loss point for the idea to be invalidated. And it has to be where it has to be. The stop has to be where the stop has to be. That's why the idea generation, these 2 points, the entry and the stop, must come first. Because if it's the other way around and you've decided, well, I want to lose 1%, and in order to do that, I have to put my stop loss here, that's retarded. That's not trading. That's trading your P&L and not the chart before you. You determine your entry based on where a logical entry is based on your system, and you determine an exit based on the logic of that idea being broken. If price comes down here, yeah, they could be hunting the low, but it's at least evidence that it's not going to teleport to the target. So the trade idea is contextual. We are here. Price looks like it's setting up to go here. If it goes here, it's wrong. Now, granted, I would probably have the stop much tighter, but for the point of the example, this is what needs to come first. You need to determine logically what the trade idea is in terms of its entry and its invalidation. And then, and only then, do you come to your calculator, determine the risk you wish to take, and have your position size be determined by your logical entry and exit points, and have it be a function of the money that you want to risk on the trade. And that is how you get these numbers. It's easy. You just execute your trade on that basis, knowing that, assuming a liquid exchange, this is in and around the amount that you are going to lose. And then you put your trade on and watch how the stress evaporates. The stress of a chart bleeding towards your stop loss is irrelevant when you've already internalized the risk, treated it like a raffle ticket. And if it hits your profit target, you win the raffle. If it does not hit your profit target, it hits your stop loss first. That was the raffle ticket. And because you're managing risk, 1% or whatever percent, a reasonable percentage per trade, depending on your confidence in the idea, you know you're going to be able to enter that raffle a lot. And if you do have an edge, and you don't deserve to be profitable if you don't have one, if you do have an edge, you know over time, by protecting your capital and firing little bullets many times, you will eventually get where you need to get to. Obviously, you need to factor in fees as well, as it can slightly affect the risk reward. You would need to, this is more like advanced stuff. I think if you can take anything away from the video, it's going to be the first part about the position sizing and the order of operations for that, determining the entry and exit, determining the risk you want to take, and letting that determine your position size. Then you can factor in your fees, and it'll amend your risk reward. And that's kind of getting closer to the margins of you know, trying to eke out all the profitability you can, and moreover trying to prevent dollars slipping away because of things you didn't factor in. Like, fees are fees, and fees cost money. And if you don't factor them into your risk reward, you could have a situation where you're entering trades that on balance won't make you money over time. And that's why you need a good risk reward, because you need to be able to absorb the fees. And obviously leverage, you need to be able to absorb the leverage costs, because you're essentially borrowing money from the exchange. But the price to pay for borrowing money from the exchange is cheaper on balance of probabilities than getting fucked by counterparty risk. And that is why leverage is an attractive option. Second part of this video was how to use leverage appropriately, which was not to blow up your portfolio value in order to make more gains when everyone's euphoric and on drugs. It's to limit the amount of capital you've committed to an exchange, so that if or when they inevitably get fucked, you are only fucked as a fraction of the amount of leverage that you used. If you have all your money in the exchange, you're not using any leverage, you're 100% fucked. If you only have 10% of your portfolio, such that you're using 10x leverage, you only get 10% fucked. And this is how the game is played. You might think, oh, Umbrin Capital must be a billionaire at this point because of how nice he calls the markets, and not yet. But this is only half the battle. This is the sexy part: calling the trades, calling the turns, being able to predict, have intuition as to where price is going to go. But at the end of the day, if you can't manage your risk, you might as well not know those things, because you're not going to be maximizing your profit, and worse, you're not going to be able to even execute on the ideas that you're seeing if you're not able to define your risk, because you're just going to be stressed all the time. You're going to be worried. If you're worried about positions going against you and monetary risk and monetary loss, then you're clouding your intuition and your brain from being able to see better trade ideas. So it's a vicious circle. One feeds the other. But if you don't have the order of operations right, you're never going to comfortably trade the markets. And you have to be able to comfortably trade the markets. No one goes to their job, give or take, and is stressed out of their head all the fucking time. Yeah, there might be some stressful days, but if the main operation of your job is making you stressed, then you're not good at it. So you have to get to a point where it doesn't stress you, because you know what's going to happen. You've run the simulations, you've run the numbers, and you're happy with the logical story you've told yourself and how you've determined that that will be invalidated. Is it always right? No. Like, could this trade come here, take out these lows, and then go to the target? Of course it could. Of course it could. It's very unlikely, but it could. But that's just the game you play. It's better to define risk than not define risk because you're afraid of this happening. In all likelihood, that will probably occur. But you don't know that. You don't know anything. And as you mature and as you get experience in the market, you really do know that you don't know anything or what's going to happen. You can speculate based on pattern recognition, but defining risk is key, and this is how you do it. So I hope this video was helpful, a little bit of a different um, video from my channel, but I felt it's important because I always say don't follow my ideas, don't trade my ideas, but obviously people are going to do that because they're really good ideas. And I felt it incumbent on me to put this out, both as an educational resource, but just as a caveat. If you don't have this order of operations, don't come crying to me when, oh, Umbrian Capital said price was going up. I got fucked because I went all in here and it wiped me out. Well, that's not my fault. Listen to what I've said in this video and that won't happen. Be disciplined, gradual improvements over time. Do not rule out the effect of compounding on your portfolio, and it'll all work out, and you'll be okay, and you'll be a professional trader. Hope this was helpful, and I'll catch you in the next video.